Imagine losing thousands because of one simple mistake. Investing can grow your wealth, but one wrong step can cost you big. Whether you're new or experienced, some traps always catch investors. Let's explore the top 5 mistakes you should absolutely dodge. Welcome to today's video on the 5 critical mistakes you must avoid when investing, regardless of your experience level. Investing offers great potential for wealth building, but it also comes with risks, especially if you're not cautious. We'll highlight the common traps that even seasoned investors fall into and provide insights on how to steer clear of these pitfalls. Stick around to learn how to invest smarter and protect your financial future. In this video, we'll dive into the most common missteps investors make. You'll learn why timing the market is a gamble, the importance of not investing money you might need soon, and why panic selling is a guaranteed way to lock in losses. We'll also cover the dangers of lack of diversification and following hype without doing your homework. By the end, you'll have a checklist to help keep your investments on track. Our first pitfall is one that even seasoned investors can easily slip into, trying to time the market. It sounds so simple in theory, buy low, sell high, but in practice, it's a whole different ballgame. The market is subject to countless factors: global events, politics, human emotion, and trying to predict all of that with any sort of consistent accuracy is next to impossible. Just ask professional investors who have dedicated their lives to it, and they'll tell you that even they get it wrong more often than they'd like. The best strategy here? Consistent investing. Enter dollar cost averaging. By investing a fixed amount on a regular schedule, you end up buying more shares when prices are low and fewer when they're high, balancing out your investment over time. It might lack the thrill of striking it rich overnight, but it's a time-tested strategy that works. The second mistake to avoid: investing money you might need soon. Imagine putting your rent money or a vacation fund into the stock market, only to have your account value swing south when you need to cash out. The market can be volatile, and while it generally trends upward over the long haul, the short term can be a roller coaster ride. Anything could happen: a market correction, an external shock, and suddenly the cash you need is worth much less. To avoid sleepless nights, ensure that only money you won't need for at least the next 3 to 5 years is in the market. Reserve your necessary funds for a high-yield savings account or a money market fund, ensuring they're safely accessible when you need them. Mistake number 3 that you need to steer clear of is the infamous panic sell. Picture this: the market takes a nosedive, and suddenly, the value of your investments has shrunk by a significant percentage. It's all too easy to succumb to the fear-driven urge to cut your losses, liquefy your assets, and retreat to safer grounds. But here's the kicker: by doing that, you're locking in your losses and potentially missing out on the recovery that history has shown often follows. To combat this, remind yourself that investing is a long-term journey, not a sprint. Instead of focusing on the immediate downturn, zoom out to see the broader trends. Historically, even after downswings, markets have rebounded with vigor. Patience and a cool head often lead to eventual gains. Next, let's talk about the risk of putting all your eggs in one basket. It might be tempting to go all in on a single stock that you believe is destined to soar. Maybe you've seen a promising tech startup or a beloved brand you trust. However, even the most successful companies can face unexpected bumps: regulatory changes, consumer shifts, or sudden market downturns. Diversifying your investments across different sectors, countries, and securities like ETFs not only mitigates risk, but also opens opportunities for growth across various avenues. By spreading out your investments, you shield yourself against unforeseen setbacks in any single area. Think of diversification as your personal financial safety net. The final piece of advice is crucial: don't follow the hype blindly. In our digital age, advice is everywhere, and some of it can be dangerously enticing. The latest buzz on Reddit or a hot tip from a finance YouTuber might sound convincing, but remember, following the crowd isn't always the best move, especially if you don't fully understand the investment. Before jumping onto the bandwagon, do your due diligence. Examine the company or fund in question, assess its financial health, and ensure it aligns with your personal investment strategy. If it's too complex or unclear, it might be a sign to steer clear. Knowledge and understanding are your strongest allies in successful investing. To recap, here are the 5 investment mistakes to avoid. Don't try to time the market. Invest regularly instead. Avoid using money you'll need soon. It's better to invest funds you can set aside for the long haul. Stay calm and don't panic sell during market drops. Diversify your portfolio rather than putting all your eggs in one basket. Finally, always research and understand your investments instead of following hype blindly. Are you ready to refine your investment strategy and avoid these common pitfalls? Share your thoughts or questions in the comments below, And if you're interested in learning how to build a bulletproof investment portfolio, let me know. I'd love to create a follow-up video to guide you through the process.